So imagine for a second a number so massive, it honestly kind of loses all meaning. $1 trillion. That's the staggering potential valuation floating around for what could easily be the largest tech IPO in human history. We're talking about the public debut of absolute artificial intelligence titans. But here's the thing, bringing a massive AI lab to the public market, it isn't just about eye-popping numbers. It's actually about a fundamental, almost impossible clash of identities.
See, on the one hand, you've got the foundational private mission of these AI labs, right? Saving humanity, literally protecting us all from the existential risks of superintelligence. But colliding head on with that, you have the ruthless, unyielding demand of public market capitalism, maximizing shareholder value. These two forces are on an absolute high-speed collision course. I mean, how do you promise to protect the world while simultaneously promising Wall Street a massive return on a trillion-dollar investment?
Welcome to The Explainer. Today, we're diving into a really phenomenal piece of corporate forensics by Thorsten Meyer. We are looking closely at the impending, totally historic SEC filings, those famous S1 documents, of the two biggest AI labs on the planet, OpenAI and Anthropic. Meyer makes this great point that an IPO isn't just some financing event, it's a crucible. It's that exact moment when grand world-saving narratives suddenly have to be translated into cold, hard, liability-bearing legal documents. All right, let's unpack these incredibly dense filings. Here is our roadmap for today. First, narrative meets audit. Then, OpenAI's heavy history, followed by pricing the unpriceable. After that, we'll hit the litigation thicket, Anthropic's trust burden, and finally, the revenue reality check. Okay, jumping right into section 1, narrative meets audit, the forced translation. So in the private venture capital world, founders get to tell a story. But in a public SEC filing, that story faces a harsh, forced translation. Think about it. In a private pitch deck, an unusual corporate structure is totally sold as a feature. Hey, we restructured to compete and protect our mission. But the second you put that in a prospectus, that exact same structure becomes a giant liability-bearing risk factor. The SEC translation essentially reads, our nonprofit foundation controls the board and, well, they might prioritize their charitable mission over your financial returns. Boom. Just like that, the core mission is officially classified as a risk to the shareholders. Moving to section 2, OpenAI's heavy history. The conversion burden. Because wow, when it comes to unusual corporate structures, OpenAI has arguably the heaviest disclosure burden in the history of public markets. They started back in 2015 as a pure nonprofit. Then, in 2019, they bolted on a capped profit subsidiary just to raise capital. Jump to October 2025, they completed this highly scrutinized conversion into a public benefit corporation, all setting the stage for a target IPO in 2026. This cap table is literally an absolute nightmare to translate into a standardized SEC document. They essentially have to explain to regulators how charitable assets morphed into investable equity. And they have to explain this staggering number, $130 billion. That is the roughly 26% equity stake that's still held by the original nonprofit foundation. And here's the kicker. That foundation still controls the board. To even get this whole restructuring approved, OpenAI had to make major concessions to state attorneys general. They formally agreed that safety and their charitable purpose will absolutely be prioritized over profit. So as a public investor, you are essentially being asked to buy into a company that is fundamentally controlled by an entity legally bound to not put you first. Wild, right? Which brings us to section 3, pricing the unpriceable, the AGI clause. See, OpenAI carries a contingency that has absolutely zero precedent in public equities. Seriously, how in the world do you disclose a massive revenue risk that's triggered by an undefined event? A prospectus is supposed to let investors neatly model and assess risks. But how do you do that when literally no one can even define the trigger? Here's what we mean by that. Microsoft holds a massive 27% stake in OpenAI, worth about $135 billion. But Microsoft's economic and revenue sharing rights alter dramatically the moment OpenAI achieves verifiable AGI, artificial general intelligence. Just let that sink in for a second. The most important commercial relationship the company has is completely gated by a sci-fi milestone that has no objective test. Sure, OpenAI reportedly has an independent verification panel to make this call, but listen, public markets absolutely hate what they cannot model. Because this AGI clause is entirely unquantifiable, it acts as a massive risk factor that public investors are going to aggressively discount. That takes us to section 4, the litigation thicket, the Musk verdict and beyond.
Remember, an S1 demands total transparency on legal liabilities, and OpenAI's Thicket, it is incredibly dense. You probably remember Elon Musk suing OpenAI, claiming their whole for-profit shift betrayed their founding mission. Now, OpenAI won that case, but as their S1 will definitely have to disclose, they actually won on timeliness, meaning Musk basically waited too long to sue, not on the actual merits of the case itself. Musk famously called it a calendar technicality. And this is a massive nuance for the SEC because it means the actual fundamental legality of OpenAI's corporate conversion was never truly tested in court. It's a victory, for sure, but one that leaves a giant question mark hanging over their entire structure. And Musk, that's really just the tip of the iceberg. A public buyer also has to weigh publisher copyright lawsuits that threaten the very training data these models rely on. Then there's chatbot harm litigation. Plus, you've got this rapidly evolving regulatory landscape, things like the EU AI Act and the UK AI Safety Institute's oversight. Bottom line, it's going to be a very, very heavy legal proceedings section in that document.
Moving on to Section 5, Anthropic's trust burden, the cleaner comparison.
Now, you might be sitting there thinking, well, their biggest rival, Anthropic, must be the much safer bet, right? Anthropic is preparing a parallel listing, reportedly raising money at a $900 billion valuation. And on the surface, their narrative is way cleaner. They don't have that super messy nonprofit conversion history or some bizarre AGI clause with Microsoft. They are very enterprise-led, and they've actually been a public benefit corporation from day one. But just when you think Anthropic has the structural upper hand, they have to reveal their own hidden burden, the long-term benefit trust. What is that? Well, it's an independent body of safety and technical experts, and they hold a special, unique class of shares. And over time, this trust has escalating rights to actually elect a majority of Anthropic's board of directors. From Anthropic's perspective, this trust is a beautiful mission-protecting feature. It keeps them safe. But remember that forced translation we talked about earlier? In an S1, this means public shareholders have a severely limited ability to elect the board. And historically, let me tell you, public markets heavily discount trust and founder-controlled governance. We saw it happen with Snap, we saw it with Lyft. The S1 completely forces Anthropic to admit that an independent trust, not the shareholders footing the trillion-dollar bill, is actually the one driving the bus. Which brings us to our final part, Section 6, the revenue reality check, gross versus net accounting. So Anthropic's governance burden is a little subtle, but their accounting burden, that might be a hard brick wall. Right now, Anthropic boasts a reported lead in annualized recurring revenue, or ARR. They're reportedly sitting at around $30 billion, largely driven by their enterprise software and that new Claude Code tool, which officially surpasses OpenAI's reported $25 billion. On paper, this looks absolutely fantastic for Anthropic going into an IPO. But, of course, there's a catch. Anthropic reportedly tallies its cloud computing credits from Amazon and Google on a gross basis. And doing that artificially inflates that headline ARR number. OpenAI, on the other hand, reports on a net basis. So here's the reality check. If the SEC steps in and forces Anthropic to use standard net accounting just to harmonize with OpenAI, Anthropic's $30 billion headline revenue could instantly plummet. That would completely rewrite their valuation narrative before the IPO even prices. Turns out, a cleaner governance structure absolutely does not save you from messy accounting. When we stack everything up side by side, just like Meyer points out, the S1 is the great equalizer. Neither lab escapes it. OpenAI has to clearly disclose its foundation control, that totally unquantifiable AGI trigger, and a very litigious history. Meanwhile, Anthropic has to disclose its shareholder limiting benefit trust and navigate a massive SEC gross versus net revenue harmonization. Both of these labs have spent years and years building complex structures to subordinate shareholder return to a world-saving mission. And now they must translate those unusual structures into cold, hard risks for Wall Street. Which leaves us with the ultimate, really fascinating question. Can unusual, mission-first governance and ruthless public market discipline truly coexist? I mean, can you really ask shareholders for $1 trillion while legally promising not to put them first? That is the real offering here. The shares, they're just the instrument. The argument itself is the product. And ultimately, the market, not the founders, will decide what that mission is actually worth.